Good morning. I'm Nicola Barrett, Chief Corporate Learning Officer at Emory Executive Education at Goizueta Business School. We're really pleased to have you with us today for Business Over Breakfast as we continue our October theme of embracing change in the new normal. This month, we've focused on finding opportunities in the midst of challenges and embracing our new environment. And we've already heard from Tom Smith, who oriented us within our current economy, and he comes back and does a fairly regular update in terms of what's happening in our economy and what that means to all of us. We heard from Dr. Steve Shepherd, who introduced us to several new technologies that we can leverage in our businesses. Richard Berlin, who shared tools and strategies for leading change effectively within teams and organizations. And this week, we're going to explore how organizations can pivot quickly to take advantage of the current environment. And then we're going to round out the month next week by discussing how to create inclusive work environments through collaboration. Today, it's my pleasure to welcome Professor Renee Dye, who's going to share some of the key lessons from large market-leading companies that have successfully pivoted their business models during the current challenging business environment. Renee is an expert in strategy and innovation and has over 20 years of experience working with leading organizations around the world. She most recently served for 4 years as the Vice President and Chief Strategy and Innovation Officer for Navigant Consulting, which is a billion-dollar publicly traded specialty consulting firm based in Chicago. During her 16 years with McKinsey, Renee consulted with organizations of all stripes, from Fortune 50 multinational companies to prominent NGOs and nonprofits and mid-cap companies on a range of strategy and innovation topics. She's worked across a variety of industries, including healthcare, energy, financial services, and many others. And her extensive research has been published at Business Harvard Review, Fortune, McKinsey Quarterly, just to name a few. She currently teaches at Goizueta and is responsible for the core strategy, organization, and leadership MBA courses, as well as electives in innovation and corporate strategy. Safe to say, we're hearing from a premier expert in the field, and we're lucky to have Renee with us today to share her expertise on these topics. As with all of our Business Over Breakfast webinars, Renee is going to talk for about 30 to 40 minutes discussing the challenges, opportunities, and lessons from organizational pivots, followed by Q&A time. However, she's also happy to answer some questions along the way. So please write your questions in the Q&A box at the bottom of the screen, and our team will do their best to feed those to her so that she can address them during this session. At the end of today's session, there's going to be a very short 5-question survey that I would really appreciate you filling in. It is very helpful to us as we think about how to continue to bring these webinars to you. So enjoy the morning with Renee. I know I'm going to, and I look forward to continuing the conversation on embracing change in the new normal next week. Thanks, Renee, and welcome.
Lovely. Thank you, Nicola. And thanks to all of you for joining this morning. I really appreciate it. And I'm very excited about today's presentation because we've all been living through some monumental challenges of trying to manage effectively through the pandemic. And for me, especially given my background in innovation, it's allowed me to consider more fully a question that I've always been interested in. That is, how do we allow companies that are large and incumbents to be able to make changes in some ways at the same rate of change at which startups can make change? All right, so according to Eric Ries, of course, the proponent of the lean startup, what he says is that famous pivot stories are often failures, but you don't need to fail before your pivot. All a pivot is a change in strategy without a change in vision. Whenever entrepreneurs see a new way to achieve their vision, a way to be more successful, they have to remain nimble enough to take it. Nimble is the operative word here, right? We think about startups as being able to change because they are small. So some famous entrepreneurial pivots that should make you smile here are YouTube, which if you didn't know it, got started as a online video-based dating service. They pivoted to a platform for video sharing. Groupon actually got started as an online fundraising for social impact projects and ended up pivoting to the commercial couponing model. PayPal, it got started beaming IOUs across Palm Pilots before pivoting to its email-based payment platform. And Slack, and this may be the most obscure one if you didn't know this, actually started off as a video game manufacturer working on this game that's featured here called Glitch. And Slack was nothing more than the direct messaging app that was embedded in the video game, which was eventually shut down before being scaled up to become the direct messaging app that we all know and love today. So again, it seems obvious that it's relatively easy for small startups to be able to pivot with alacrity and very successfully. Now, if we turn our attention back to the corporate world, there are some very infamous failures to pivot effectively that have taken root in the popular imagination, some perhaps more deservedly than others. So Kodak, of course, was a market leader in the chemical-based print, photography, and camera segment of the market. And when digital cameras and digital prints came along, they failed pretty spectacularly, not for lack of trying, but just because it was a much more difficult and different market space for them to compete within. Blockbuster, of course, started off in the retail-based VCR and DVD movie rentals and failed to effectively pivot to mail-based and streaming movie rentals. So Netflix, at a particularly low point in its career when it was facing the prospect of failure, went to have a meeting with Blockbuster to ask whether or not Blockbuster would be willing to buy them for around $50 million. The Blockbuster executives laughed them out of the office, which I'm sure they are still telling that regretful story to this day. Palm, remember Palm Pilots, the leaders in the personal digital assistant market? They completely failed to manage the transition to smartphones. So if we take a step back and we look at these different natures of pivots and why it's so easy for entrepreneurs to pivot, what they have on their plates are limited legacy assets, small organizational scale. They have merely handfuls of employees. They have few really important administrative needs that they have to attend to. And they have almost no reporting requirements because they're not public yet. And they have oftentimes a private investor base that's extremely manageable. For incumbents, it's a completely different ballgame. Of course, they've got extensive legacy assets. They have massive organizational scale. They have thousands, even hundreds of thousands of employees, oftentimes around the world. Their administrative needs and oversight and reporting requirements are extremely stiff. And their investor base is incredibly big and oftentimes heterogeneous and public, right? So again, it seems obvious that of course you can pivot when you're an entrepreneur, and of course you can't when you're an incumbent. However, COVID has given us a tremendous laboratory in which to test this hypothesis. And I want to thank all of you for your resilience in being out there on the front line of management, in getting the world through the pandemic. It's a very challenging time to be a manager. The good news is it's a wonderful time to be someone who studies what's going on in the world around us. So I seize the opportunity to imagine what happened in the wake of COVID. So one tiny virus, meteoric industry and company impact, right? And we see some of the biggest COVID winners and losers, for example, in retail here. And I'd just like to remind everybody that there are certainly industry sectors out there like hospitality and like travel that have been hit uniformly across even subsegments of the market. But for many of the other impacts of COVID, what we've seen is that even within a single industry like retail, you have some retailers that are doing phenomenally well, like Amazon, like Home Depot and Lowe's. And at the other end of the spectrum, you've got mass challenges in clothing and in obviously restaurants. And of course, the most notable failure that we have throughout the COVID pandemic after travel and hospitality, where we haven't had massive bankruptcies yet, is in the retail sector. Now, we could argue that there were already some trends that were going on within the sector that were only amplified and accelerated by COVID, but certainly this has been a bankruptcy season in retail that the world has never seen before. So with all that behind us, I'm going to ask you to take a poll here. And Jasmine, if you could go ahead and launch the poll that says organizational change speed. And I want you to reflect upon, prior to COVID, how long would you have predicted that it would have taken your company to devise and implement an all remote workforce solution? So go ahead and take a few moments and respond to that. All right, let's see, just a couple more seconds to get folks' responses here. All right, Jasmine, why don't we go ahead and close the poll and share the results, please? All right, so many of you said that it would have taken you 18 months to devise and implement an all remote workforce solution. And I would say that's very similar to what our respondents said in a McKinsey poll around some of the impacts of COVID. So for remote working in particular, the estimate of response time pre-COVID was right in line with what y'all said, 454 days. So nearly 18 months. In fact, the amount of time that it took to transition all workforces to all remote ended up being about 11 days. So for various organizational changes, and Jasmine, you can take these poll results down. For various organizational changes, we see that the actual COVID response time was 20 to 25 times faster than estimates. And let me just show you some of what respondents said within this McKinsey survey, right? So increase in remote working and collaboration was the fastest transition, not surprisingly, just given the immediacy and urgency of the situation. But again, people foresaw consumer demand for online purchasing and devices, only taking nearly a couple of years, when in fact the accelerated development of consumer demand for online was really more around 22 days. Advanced technologies expected to be 672 got implemented in 26 and a half days. So again, what we saw in terms of the actual ability of businesses to respond to some of these changes that came at them super fast was far, far superior to what any of us would have expected was the capacity of our organizations to respond to this sort of change. And Tata, just as one example, has a mind-boggling 450,000 employees, right? They're one of the world's largest management consulting companies. What they are imagining that they're going to do is continue to work from home after the pandemic. The digital disruption is so significant that most of us cannot imagine the degree. The pandemic has accelerated these digital trends that are going to stick long after they're gone. All right. So again, just to reiterate what we've looked at here in terms of especially digitalization of the marketplaces that we all compete within or operate within as nonprofits, is that they got here in a hurry, right? So from December 2019, which is the furthest gray bar over here, to the black of July 2020, what a difference a 6-month period can make across the globe in terms of the rapidity with which these changes in digital are coming at us. So what I want to do now is I want to take us through a couple of case studies around organizations and how they responded to COVID to see what we can learn about management approaches and what has worked well for companies that have successfully navigated the COVID challenge. So Walt Disney said that you may not realize it when it happens, but a kick in the teeth may be the best thing in the world for you. And I think in both of the case studies that I've selected here to share with you today, there is a lot of goodness involved in the very real management challenges that were brought about by the pivoting over to a post-COVID world that are going to stick long after COVID has declined. So I'm going to go ahead and move on. And if there are any questions, please interrupt me at any point. I'd be happy to entertain your questions and have more of a dialogue as we go along. Okay, so to warm us up for Kroger, let's do another poll around online grocery penetration. So the first thing I'm going to ask you about is, prior to COVID, which country do you believe in, I'm sorry, Jasmine, you can go ahead and launch this poll. Prior to COVID, which country had the highest rate of online grocery sales? And your choices are the United States, the United Kingdom, France, Germany, and Italy. So I'm going to let you mull over that for a few seconds. Tell me what you think is the most digitally advanced grocery retailing market of the 5 that are listed here. All right, we are almost at 80%. We'll go ahead and end the poll then. Okay, all right. So what y'all said collectively is that Germany had the highest penetration rate of online grocery sales. Okay, hold on to that thought. And now we're going to launch our second poll, which is, after COVID, or after the onset of COVID, tell me which country you believe had the largest increase in share of online grocery sales, right? So from whatever starting base they had, which one actually ramped up the most? Again, same set of countries to choose among. All right, Jasmine, we can go ahead and stop that and then share the results. All right, so y'all believe that the United States had the highest rate of increase in online grocery sales. Okay, all right, why don't you, if you would take down the poll, Jasmine, just remove it from the screen, that would be great. And let me show you the actual numbers here. So this is from a really excellent Bain article on online grocery. And what you'll see is that the initial rate of online penetration of grocery sales was highest within the UK. And the United States is actually reasonably low, but not quite as low as Germany or Italy. The rate of increase within the United States, which y'all seem to think was going to be the biggest, was still reasonably moderate. The US started from about 5.5% penetration of online grocery sales and really only bumped up to about 6.1%. So the UK is actually one of the most forward acting and thinking in terms of online grocery sales. And again, that may surprise some of y'all. Feel free to throw in a question as we come along here. I think I see a question in the Q&A. I'll let the folks from the Executive Education Office let me know if they want to go ahead and introduce that here now. All right, so let's turn our attention to Kroger then. All right, so we now have a landscape to put Kroger within, which is, they have been doing tremendously well, right? They are the second leading grocery retailer after Walmart. They have 123 almost billion in sales, 122.3 billion in sales. They have nearly 2,800 stores around the United States. They have nearly 30% of their sales by SKU within their private label brands, which is an interesting but not directly related note that has been instrumental for their success in this market. Okay, so Kroger winning prior to COVID, but let's talk a little bit about the challenges of omnichannel economics for grocery retailers. So grocery retailing is already an incredibly thin margin business, right? So if you're lucky, you might be getting 4% margins. If you're on the bottom end of the performance of grocery retailing, you're really only taking home about 2% margins, right? So incredibly thin margins. It's a volume-based game. Along comes omnichannel. And you can see here on this chart, again, from the Bain study, that home delivery versus click and collect has by far the most inferior economics, right? So if a grocer is actually picking from their own stores and delivering to the consumer's home, they can be expecting margins of negative 15%. If they're picking from a dark store, 11% margins. If they're picking from a centralized warehouse, -8% margins. And if they're picking from a store by a third party, we're still at -5% margins, right? So for the click and collect, it's actually a little bit better, right? So picking from a store is only -5%, and you can get up to 0% break-even margins if you've got a third party picking from the store. So obviously the delivery component of getting groceries to the consumer is incredibly expensive, right? And going forward, the Bain study suggests that centralized fulfillment centers that are automated will have break-even margins, whereas micro fulfillment centers that are fully automated will get you back into the lower end of the operating margin performance for grocery retailers. So again, it's not a terribly optimistic set of projections around the economics of online grocery retailing. All right, so let's move on here and talk about the impact on Kroger's current operations.
Hi, Renee. I'm sorry to interrupt. We have our first question here.
Yes, please.
Any ideas what drives the UK online sales?
That's a great question. One of the things that may be driving them is the fact that Ocado is a British company, and I'm going to show you a video clip in just a minute that looks at their very sort of industry-leading practices around automation and robotics in grocery retailing that went directly to the delivery market. But honestly, I don't know beyond that. If anyone else in the audience has a point of view, I'd love to hear it. I mean, I do know I lived in London for a couple of years, and I do recognize that there were already some trends within grocery retailing that were in advance of the American market. So they had a quicker pivot to some of these smaller urban footprints that have proved more economical and more accessible for consumers within urban settings that we've been a little bit slower to adopt here in America, which has always been more suburban based in terms of its retailing landscape. So it looks like we may have something on the chat function too. Let me just pull this up real quick. Yes, we'll be talking about Ocado. So I don't know. Let's come back to this and see if we have any other thoughts on this as we go forward. So let's talk a little bit about Kroger, and then we're going to look at Ocado. So in terms of the partnerships that Kroger was able to leverage in order to be able to successfully pivot to be able to deliver online as well and as fully as they did forge a partnership with Instacart back in 2017, simply because the economics are unattractive for them to be doing this all internally. Instacart is a sort of plug and play partner out there in the market. The original partnership was for 45 different metropolitan markets. They actually scaled that to 75 more in 2018, bringing them up to 120 plus markets. And they do pay a commission to Instacart on the delivery orders, right? So in terms of labor, what we would expect to see is that grocery pickers could become quite specialized in shopping for family-specific nutritional needs. The store design, current grocery stores are not optimized for an efficient online operation. They're going to either need to change to automate in-store picking, which is Walmart's current pilot, build new warehouses or dark stores, right, where consumers never set foot, designed for robots to navigate, and Kroger's current approach through the Ocado partnership, or perhaps create many smaller stores. These are the micro fulfillment centers with limited product options to simplify the picking process, which is what the Israeli company Fabric is currently doing. So let's look at the financial impact of grocery delivery. So Kroger did decide to make a $251 million investment in Ocado, which gave them 5% in the share of the company to build 20 robotic warehouses here in the United States for full online fulfillment. They say it's an exclusive partnership. We'll see how that plays out going forward. So Kroger claims that they're able to capture a larger share of the online customers' total basket, right? So they're getting a bigger spend from their already existing customers, We do know that online orders, as they're currently configured, are less profitable due to the additional labor for picking and delivering. We also know, again, historically, that consumers that convert to online shopping usually take 3 to 4 years before they're as profitable as in-store customers. However, we also know, according to Kroger's self-reported second quarter earnings statements, is that digital orders, they claim, became profitable for them on an incremental basis in Q2, and that they project that these are going to continue to increase with automation and personalization. So Kroger's gross margin, despite the growth in online shopping, has not dramatically decreased, right? So you can see what the numbers are there. Now, I will say that we need to keep in mind that the share of online grocery penetration within the United States market is still quite tiny, and that Kroger has benefited from massive upticks in their typical foot traffic for their brick and mortar stores. So it's a little hard to tease out the impact of online grocery versus traditional grocery retailing in their reported aggregate margins here, but we will take them on faith when they say that they become profitable on an incremental basis. All right, it looks like we may have a second question in the Q&A. I will pause here for a minute to see if there's anything that folks want to ask before I play this really fascinating Ocado automated warehouse video. So this is from the United Kingdom, where Ocado hails. And I just wanted to give you a chance to have a look at the nature of their operations, because it may or may not align with your mental model of what you think the future of grocery retailing for online is going to look like. Okay, let's go.
Renee, sorry.
Yep.
Just going to ask a question real quick before you dive into that. There was a question about what share of online grocery sales impose a delivery charge?
That is a good question. I don't know the answer to that. Yeah, I don't know.
Okay, we have some other commentary and whatnot, but we'll watch your video and hopefully some more questions will come in during that time.
Okay, sounds good. I'll go ahead and stop it there. For me, I just find this such a stunning video because of the complete absence of any human beings, right? This is a purely robotic populated warehousing space that is going to have, huge implications for also the labor force within the grocery retailing market if we do continue to see the explosion in demand of online retailing that we've experienced over the last few months within COVID. Sorry, let's get to the next page here. All right, backing up here. All right, so the shift to online grocery shopping is going to have a long-term impact. And I'm going to come back to the previous question. And while I don't know the exact share of organizations that are imposing online delivery fees, I'm going to guess that in order to make the economics profitable, we will begin to see a standardized industry practice of either a subscription-based membership model where you pay like an Amazon-like Prime, annual subscription fee of say $99 for your Kroger delivery, in which case your deliveries are free. In lieu of that, I would expect to see, a standardized trend of imposing delivery fees, either by the last mile delivery, who may be the Instacart, or by the actual retailer, which is Kroger, and they'll sort it out between them. So I would expect to see that happen over the long term. What I suspect is going to happen is more of the Amazon Prime model, especially as the likes of Kroger really want to make sure that they are front and center in the relationship with the customer, and they want to build on cementing that relationship. All right, so Kroger sales online grew 92% in Q1 and then 127% in Q2, which is pretty staggering growth. But again, we're starting from quite a small base in the United States. They currently offer 2,000 grocery pickup locations and 2,400 delivery locations. They claim they can reach 97% of their customer base. And again, what they would strongly prefer people to do is click and collect because of the superior economics of that channel. So what do we think is going to happen in the future? Well, there is real consternation about the role that Instacart is playing within this market. So Instacart was a godsend both to consumers and to retailers who frankly were not yet ready to scale up their online offerings. However, there is concern that Instacart may end up controlling the nature of the customer relationship, right? That they will capture the data, they will own the customer relationship. And that is causing a lot of worry to some of the retailers out there. And it remains to be seen the extent to which the Krogers of the world are going to continue using Instacart as their partner for last mile delivery, or if they want another solution that they feel that they can better control, right? And it may also be that more specialized grocers may find it easier to enter this market without having the barrier of brick and mortar to pay for, and certainly we've seen this happen in the direct to consumer branding market for apparel, for shoes. Essentially, the entry barriers drop to almost zero when you don't have to maintain an offline presence. And we could expect to see more of that happening within the grocery market as well, which would, of course, be a problem for the likes of Kroger, especially if what they're going to do is cherry pick some of the higher margin, more profitable items within the basket that the consumer has. We're going to expect to continue to see the largest grocers, and that's the Walmarts, that's the Krogers, that's the Safeways, and that's the Costco's and others, continue to consolidate power through these massive investments in fulfillment centers, however they're configured. So that will absolutely continue going forward. In terms of the customer migration to online orders post-pandemic, again, in the United States, we have a fairly muted shift over to online, but 60% of the consumers who were surveyed recently said that they plan to continue to reduce restaurant visits and increase in-home dining post-pandemic, and that the transition to online is still going to be slower for some segments of the population who either don't want to or can't afford to make these, big purchases on a multi-week basis for grocery orders so that they can actually minimize their delivery expenses. All right, I'm going to continue on. Do we have a question?
Yes, we do have a question. What data is there about the emotional link people have to grocery shopping, i.e. selecting for their family, thrill of the hunt, best produce selection, and the impact to auto pick or gig picking models?
So it's a great question. The degree of emotional involvement that consumers have with their retailer in the grocery segment is highly variable depending on who the retailer is. So there are certain companies like Whole Foods, like Trader Joe's, that have extremely high emotional involvement among their user base, especially Trader Joe's. I don't know exactly what the differential is between that and your more traditional retailers, but it's considerably less, of course, for your Krogers and for your Publix. They wouldn't like it to be that way. They're doing everything that they can to actually drive greater customer engagement and loyalty. And it may be that online delivery is actually going to be helpful for them in being able to continue to try to monopolize the grocery visits that a given customer may have. I know for myself, for instance, right, I'm largely a Kroger loyalist, but if I'm passing a Publix and it's easier to get to, Kroger is just out of luck, right? So it may be that they are looking forward to a time when they will have a stronger relationship and direct line to the customer through their online business. And that may help offset the lower emotional engagement that some of these stores have. Trader Joe's is an interesting case, right? Because I don't know that they ever have any desire to get into the delivery business, just given the nature of the business model that they have. But we'll have to see how that all plays off. So, again, relatively low emotional engagement currently for the massive grocery retailers, but that may be changing going forward.
Renee, lots of great questions coming in here. Another question from Lewis. What do you think is going to be the role of third-party logistic companies in the future of retail business?
I think it remains to be seen. You know, as I was mentioning earlier about Instacart has positioned themselves brilliantly to be able to perform well in the current market space. And again, they were kind of your only option if you needed to scale up in a hurry. So I think Kroger made very canny use of Instacart services, as have many other retailers that are out there. But I think that they are going to be viewed as an existential threat to many of the retailers out there just because of the nature of the customer relationship. So there may be a desire to either supplant them with something more proprietary or perhaps co-op shared across a variety of players within the market. That could be one scenario that would unfold. Another scenario, however, is just that the retailers decide we are in the business of selling grocery and household items, and therefore all we need to do is secure the relationship with the customer. And they can negotiate with Instacart about who has access to customer data, who controls the customer relationship, such that they can outsource forever the logistics of delivery to the consumer, right? So I think there are a couple of different models that could possibly unfold within the future. We'll have to see which way it goes. You know, it's a little hard to unwind some of these relationships that become quite sticky. So Instacart is not going anywhere anytime soon. The only question is, are they going to continue to be the preferred partner for the largest retailers out there who may feel some threat from them? All right, more questions?
Yes, we have another question. How would you assess the risk of future antitrust actions against those grocers who invest in delivering what and how customers are requesting?
That's a really interesting question. We're talking and thinking a lot about antitrust these days. I have to confess that I haven't seen much discussion of it within the grocery space, because it just doesn't have the same degree of industry concentration as some of the other industries out there that folks are, you know, top of mind these days, like high tech. So I think you would have to see much further concentration in the market for there to be any meaningful discussion of any antitrust action against the major grocery retailers. And I don't know that I see that coming to pass anytime in the next kind of 5 to 10 years. It could be in some future state where, you know, Walmart continues to monopolize grocery retailing, you know, perhaps a Kroger or a Publix exits the market through acquisition or through bankruptcy, and then it might become more concerning. But right now, I just don't see that having much interest to the DOJ or the FTC in terms of considering antitrust action for this marketplace. But good question. All right, any more questions or should we carry on?
We have a few more, but I think maybe we should continue and we can visit them in a bit.
Okay, we'll circle back if we have time. Okay, so as I reflected upon why I think Kroger has been able to manage this pivot over towards online as quickly and effectively as they have, there are a whole variety of different types of leadership decisions and actions that the team took that I think positioned them very favorably. Back in 2015, they had the foresight to understand that online is going to be an important component of our strategy going forward. They actually purchased an online vitamin brand called VitaCost for $280 million, in part because they wanted to learn from the best practices of a purely online retailer. In 2016, they acquired 84.51 in order to further develop their data analytics and revenue streams. In 2017, the CEO launched this broad vision called Restock Kroger. And it had a variety of different pillars, too many to call out here. But one of the important things they did back in 2017, as I've already referenced, is that they figured they needed a partner on the delivery and fulfillment side, hence the road to Instacart, which they then scaled up in 2018. I've talked about the private label products. Unfortunately, we don't have enough time to do that justice here because it's been a really, really fascinating facet of the Kroger strategy that's proven very effective in the marketplace. They have developed external partnerships in order to extend their product sales. They have partnered with best-in-class digital providers such as driverless delivery company Nuro. Their time has not come yet, but who knows, maybe it will. They've also partnered with Microsoft to try to pilot these connected store experiences. I talked about the $250 million investment in Ocado. And, you know, they've also acquired one of the potentially failing sort of meal kit delivery services, Home Chef, and brought it in store, which was always the right place for those product offerings to be. So I can't point to a single thing and say Kroger got this exactly right, but I think they were very, very thoughtful in anticipating the future that was going to come to them and position themselves to be able to pivot successfully to that. Again, I don't have time to do it justice here, but I will say that one thing that Kroger has done extraordinarily well is they have developed ancillary revenue streams around customer data and analytics, which they sell to the major CPG companies, which has helped cushion them against the low margins that they command, and especially the even lower margins as they transition to online. So they have done, and the private label products, of course, give them more margin on every product. So they've been very holistic in their strategy development to be able to successfully compete in the world going forward. All right, that was it for Kroger. We're going to turn our attention now to a very different market segment, which is healthcare. And I tried to pick something that was about as opposite to the grocery retailing marketplace as you can imagine. Healthcare was a pretty good exemplar of a very different set of pricing transparencies and availability. But it turns out that even healthcare can move lightning fast when it has to, right? So this is from an interview given to Healthcare Dive with Roy Schoenberg, who's one of the CEOs of one of the many sort of online healthcare provider platforms that's out there. And what he said is that, you know, there are generations when nothing happens. There are decades when nothing happens, and there are weeks when decades happen. And I think that's a fair approximation of what we're about to talk about in healthcare. So let me launch now another couple of polls. The first one is your past telehealth experience. So the question I wanted you to consider is, you know, which statement best describes your personal use of telehealth services? So go ahead and vote on this, and then we'll talk about what the future is going to look like for telehealth. All right, we are at 70%. Let's get up to 80%, and then we'll close the poll. All right, let's go ahead and close it and report the results. All right, so there is a small fraction of this population, about 3 respondents, who have been a regular user of telehealth for more than a year. So those are our progressive thinkers and actors here. But it sounds like the majority of you in the respondent pool have actually never used telehealth services, or you've only tentatively tried them because of COVID for the first time. Okay, good. Let's stop share results, and then let's launch the next poll, Jasmine, around the future of telehealth. So now I want you to contemplate, given everything that you have experienced through COVID, how likely are you going to be to use telehealth services in the future? All right, let's go ahead and cap this and share the results, please, Jasmine. All right, so I find this really, really interesting, right? Because even though the majority of you have not used them in the past, nearly all of you are very likely or somewhat likely to use them going forward. And this could be, you know, cataclysmic inducing for an industry that has always depended on hands-on delivery of care. All right, thank you. Let's go ahead and shut down the poll here. And I'm now going to, first of all, share some results with you from a different survey. And this is a consumer, and it's a set of consumer-based surveys and then physician-based surveys that asked, first of all, how has COVID-19 changed the outlook for telehealth, right? And again, similar to what y'all said, only 11% of respondents had actually used telehealth in 2019. To going forward, over 3/4 of respondents said they would be interested in using telehealth going forward. For providers, the number of telehealth visits pre-COVID multiplied by a factor of between 50 and 175, and that's just for your traditional physician practice. And 57% of providers now have a more favorable view of telehealth than they did before COVID-19, and 64% are more comfortable using it. Of course, since we're in healthcare, there is a regulatory angle that was largely lacking in grocery retailing to the same extent. And that is, there has been a huge barricade to the adoption of telehealth in the form of reimbursement practices for the Centers for Medicare and Medicaid Services, CMS. And they sprang into action to rapidly approve 80 new services, as well as to waive some of the more restrictive requirements around site origination and where these services can be delivered. And it was only because, especially of this last regulatory relaxation, that healthcare organizations were even able to respond as effectively as they did. So the case for telehealth has been clear for some time, right? So we know that 42 states and the District of Columbia already had commercial payer statutes in place for telehealth. And over 90% of providers, executives for healthcare providers said they either are currently offering or developing telehealth application. 84% of employers in a Willis Towers Watson survey said their employer offered some sort of telemedicine service. We know that the cost advantages of telehealth are significant, right? So on average, a telehealth visit versus an in-person visit saves patients and payers between $20 and $120 approximately. So no surprise that this is going to be a large and rapidly growing market going forward. All right, so I'm going to talk you through one case example now, and that is the telehealth pivot for a multidisciplinary provider clinic. So prior to COVID, the telehealth penetration rate for this particular clinic was less than 1% of total visits. The telehealth penetration rate during COVID ballooned to 70% of total visits, or 1,000 visits per day. So the time to scale was only 4 weeks. And to show you what this looks like in graphical form, you can see the number of daily telephone visits starting from essentially 0 until suddenly, the onset of COVID around the 16th of March, and the massive sudden spike in the delivery of telehealth services. Same for video, a little bit longer to get that off the ground, but once it got up and running, it got up and running in a hurry, right? So this is an organization that had to figure this out in a real hurry. So in case you were interested in seeing what some of these look like, and this information is in a Journal of American Medical Informatics Association article. Even within ICU, they were doing virtual mobile consults. And you can see here that this quasi-robotic creature is able to get a specialist physician consult to the bedside of a patient and be able to provide that kind of care, even within a setting that we would traditionally not think of as being digitalizable. All right, so what exactly did the clinic do in order to make this happen? Well, again, tremendous organizational lift was required. So on the organizational structure side, they developed a centralized call center that trained providers and patients to use telehealth, and they had to staff any way and every way they could. So they took existing staff and repurposed them. They had to hire in new staff. They put medical students and deployed them here. And they took some super users and used them to cascade the best practices that they had already encountered in their use. For the training model, they had to adopt again, a cascading model of a train the trainer approach to onboard over 1,300 providers in a mere 3 weeks. And at the same time, they had to be providing substantial tech support during actual patient visits. As with Kroger, there was an external partnership that was incredibly important for them. They selected the extended care platform to be able to offer the foundational video visits that was integrated into 3 different electronic health record patient portals. and to help manage the virtual patient waiting rooms. Again, lots of HIPAA requirements here and data privacy and patient privacy that had to be considered as they selected the vendor that they wanted to go with. And then the other thing that they had to do is try to get up and scale out peripheral devices for certain patients, like high-risk OB patients, that would facilitate the remote visit and remote monitoring. So again, in some ways they moved more quickly than Kroger did. And again, this is a sector that has historically moved very, very slowly, in large part, but not entirely, because of the regulatory environment in which it operates. So I'm going to stop there and see if we have any questions that I can answer before I move to the last page of the presentation.
We do have a few questions. How does telehealth work for blood or lab tests?
Well, for now, they're not, patients are not permitted to draw their own blood. So you do actually have to go into a diagnostic facility or a lab facility in order to have a blood draw, right? So that can be low contact and it can be protected, but it's obviously not contact free just because of the nature of a blood draw. So there's no replacement for that service right now. That can take place either by someone visiting the patient at home and doing the blood draw, or having the patient go to a laboratory in order to have the blood draw. So that unfortunately hasn't changed all that much. And I'm sorry, what was the second part of the question in addition to blood draws?
Hi, Renee. I don't know if Kristen's got that. I'll just jump into the next question if that's all right. There was a question about, what does the data tell us about the differences in telehealth usage by urban, suburban, rural, and remote populations?
I haven't seen a breakdown of the data yet that would suggest one way or the other. I do know that some of the earliest applications of telehealth were in rural markets, precisely because of the lack of availability of qualified medical staff within some of the most rural parts of America. So in fact, that's one of the reasons that the CMS statutes were written the way they were. They were to specifically enable rural care delivery for some of the markets that were underserved by traditional physician practices and provider practices. So I think going forward, you're probably going to see much more rapid uptake among more urbanized populations that are more technology forward. But I don't know that that we have enough data yet to be able to tease apart the way all of those trends are going to unfold in the marketplace. But it's a good question. It's something we'll all be watching very closely.
Okay, Renee, this will be our final question. Let's see. In your medical surveys with respect to telehealth, did you break out by age of respondent and or education to understand market use differences?
So in this particular survey, I do not recall having seen any breakout by education. So it may be that the data was there, but I don't think it was. Again, going forward, I think we'll be able to have access to a lot more anonymized data that will enable us to understand the continued penetration of telehealth. I mean, I do think that we're at a bit of a pivot point. So let me qualify this by saying that the use of telehealth after the world started to reopen after COVID plummeted, right? So it hit a high of 69%, and it was back down to 21% as of September, which is the last time I looked at the data. So I think for now, even though patients may express an interest in using telehealth going forward, the behavioral changes that are going to be required for both physician practices and for patients to scale this into ongoing behavioral change is going to take some time to kind of permeate within the market. There are ways that payers and physicians can try to incentivize customers or patients to change their behavior. But I think, it will take a longer time than we saw scale up to COVID. And I would point to y'all's own survey results during the course of this as being emblematic of what is probably happening within the market, although the vast majority of you said that you were very interested in telehealth going forward. In fact, those of you who have changed their behavior is still, well behind those figures that are reporting being interested in this. Okay, good. Thank you for all the excellent questions. And let me, in the interest of time, just skip over to the last slide here. And that is, I wanted to try to, across these two very different elements of rapid pivot in market segments that couldn't be more different from one another, try to extrapolate what I saw as the enabling conditions or the best practices that caused the pivot to be possible in the first place. And these were the extrapolations that I made based on these two case studies. One is this notion of decisive leadership. You know, these are organizations that got moving and mobilized immediately because they realized they had to. Now, there was an urgency in both of these sectors because people have got to eat and people have got to get medical care, right? So there was no sort of sitting around kind of waiting to see what's going to happen. Instead, there was a burning platform that is unlike any that actually I have seen in my entire 20 plus years of working in the business world, that caused organizations to make fast decisions and hard decisions at a pace that is unprecedented. But they had to do it and they were very decisive in what they decided to do. Okay, prior investments that enabled the rapid pivot. We saw that most clearly in the case of Kroger, but again, there was already some investment in telehealth, telemedicine that enabled a scale to be developed on top of that. So without any of those prior investments having been in place, it would have been a much more onerous shift. The third tendency here that I think underlies both of these case examples is that unlike hospitality and travel, where you had a crash and burn of consumer demand all at once, this instead was consumer demand that was not only undiminished, but actually burgeoning, you know, again, for grocery purchases or for healthcare because of COVID. So companies were able to rely upon that continued high consumer demand to support their offerings and to be able to support the investment in their offerings. It's hard for me to imagine that you would have had the same kind of rapid pivot in industries that saw a fall off in consumer demand. Fourth, technology partnerships. Most of these companies cannot do this alone. So the ability to understand that and select a technology vendor who is going to be your true partner in helping pull off some of these digital deliveries of products and services has been critical to these organizations. And then finally, as we saw in the healthcare example, the relaxation of regulations is going to be essential in some sectors for the full digital effect of the COVID economy to be able to take hold. And those are going to have to be more longstanding. There's already legislation in front of Congress to make the changes that were put in place because of COVID permanent, such that you can have the full sort of deployment and the development of the market for telemedicine going forward. So our last, so let me just leave you with a little bit of a fun quotation, then I'm going to have our last poll before we close out here. So this is from 1348 in the wake of another plague, the Black Death, bubonic plague. Agnola de Toro said, you know, and then when the pestilence abated, all who survived gave themselves over to pleasures, monks, priests, nuns, laymen, women, all enjoying themselves, none worried about spending and gambling, and everyone thought himself rich because he had escaped and regained the world, and no one knew how to allow himself to do nothing. So the question I have for you for this last poll is this. So looking forward, which statement best describes your perspective on the industry changes that have been catalyzed by COVID? And I would encourage you to reflect specifically on your own industry. So do you think that these changes are here to stay because they just accelerated underlying trends, that whether or not they're going to have longevity is going to depend on technology and regulations? And then finally, consumers are going to revert to previous behaviors and preferences once the COVID coast is clear. All right, let's take just another few seconds and get the votes that we have here. Then I'll show you what the group thinks. All right, let's close it out here and I'll share the results with you. So it was about evenly split between those of you who think the future is now, it's here to stay, and those of you who think, well, it's actually just going to depend on whether technology and regulations keep pace with underlying trends. And very few of you believe that consumers are immediately going to revert to previous behaviors and preferences once the COVID coast is clear. And in line with that, the last bit of survey data I have to share with you is entirely in alignment with you, and this breaks it down by type of change. So the clear takeaway here is that the largest shifts during the crisis are also the most likely to stick through the recovery. So changing customer needs or expectations, 62% respondents said that those changes are here to stay. Increase in remote working and collaboration, right? 54% said those changes are here to stay. Asset migration to the cloud, 54%, 53% in consumer demand for online purchasing and services, and so on, right? And then we have a drop off after data security. But you can see that, you know, the preponderance of respondents agree with you that we think that going forward, we tripped a trigger that catapulted us forward about 3 to 5 to 8 years, depending on the industry, depending on the nature of technology that's in place to support the industry. But we're not going back, that a lot of these changes just came at us harder and faster than we expected, but they are definitely here to stay. All right, thank you very much for joining me today. Here's my contact information. If any of you want to reach out to me, you can follow me on Twitter too. Although I have to say I use it to post articles for my class as well to drive home some of the lessons that we cover in the strategy and innovation classes. And I have a blog as well, stratitech.com. I really appreciate your joining me today and thank you for the thoughtful questions. If we have any time remaining, I'm happy to turn over and take any final questions, but I'll leave that up to our team here as to how you want to close out today's session.
Thank you, Renee. This has been fantastic. We are unfortunately at the end of our time, although we have had so many great questions, and we are going to pass those along to you. And we encourage everyone to take down Renee's contact information and reach out to her if you want to know more. We really appreciate you taking the time to be here today. We have next week, we have Harnessing Collaboration to Reduce Social Class and Equity in our Business Over Breakfast series, followed by another Economy and Me election edition, which should be very interesting, and then some marketing sessions in November. We also have, sorry about this, we also have plenty of open courses that we always have running, and you are welcome to go to our website and learn more about those courses and who will be teaching them. And if you would like more information or to register, please don't hesitate to reach out or browse our website. We are going to have a brief survey, which I think has already popped up, to get feedback on today's session, and we'd appreciate you filling that out. It only takes 1 to 2 minutes to complete and is a huge help to us. So with that, thank you for being here today with us. And thank you again, Renee. That was a really fascinating session, and we appreciate you taking the time to be here with us.
Yes, thank you very much.